Hi, this is Samer Halal, financial advisor from Cleveland, Ohio. I suspect that a main reason people get so anxious around tax time is that they've delayed so many important things, like organizing their paperwork, contacting their accountants, and taking advantage of opportunities that could lessen their tax burden. While you're on your own for tackling the first two, I can help you with the last one, which is taking advantage of opportunities that could lessen your tax burden. In fact, there are a number of things that you can do that could potentially reduce your taxes when you prepare them next year that we should be looking at and considering today. Let's take a look. First, let's look at losses. If you think your investments will produce capital gains, whether they are short or long term, you can offset these with capital losses. For assets that you hold less than a year, any gains are considered short-term gains. These are taxed at ordinary income, which is usually ranging from 10% to 37%. You can offset these with short-term losses. For assets that you hold longer than 1 year or considered long-term, any gains are taxed at a top rate of 20%, which you can reduce by, you guessed it, long-term capital losses. Now, if your losses are greater than your gains, good news here, kind of, is that you can deduct up to $3,000 in capital losses against your ordinary income on that year's tax return and carry forward any unused losses to future years. Because of this, you might want to avoid short-term gains, since these are taxed at a higher rate. To do so, if you believe you will have a short-term gain for the year, try to either offset it with a short-term loss or consider holding the asset for a little bit longer past the 1-year mark from the day you purchased it, when they will become long-term assets and then they are taxed at a lower rate. This requires that you review your portfolio regularly and estimate your gains and losses. Most capital gains and losses are triggered when you sell the asset, offering you control over the event. However, others, such as mutual funds for instance, are difficult to predict as they are made up of multiple numbers of assets, and mutual funds make taxable capital gain distributions even if you are to reinvest the proceeds. So if you find assets that have performed poorly throughout the year, consider using them to offset your gains, as it will reduce your capital gain tax. Keep in mind that it's beneficial to elect a loss before a gain, because you can always carry over the unused losses to future years, whereas capital gains are taxed in the year they occur. As tax laws change often and are complex, consider speaking with a tax professional to help you manage your tax burden, and make sure that you get with me or your financial advisor to review those embedded gains and losses and decide which ones you want to trigger before the end of the year. Thank you so much for your time. If you have any further questions, please do not hesitate to reach out and let's talk.